The Federal Reserve has announced it is cutting interest rates for the first time in more than a decade. CBS News business analyst Jill Schlesinger joins me now on the phone. Jill, the last time the Fed cut the rate, it was in 2008, and things were looking a lot different back then. That was during the recession. Now, currently, unemployment is hovering at record lows. The U.S. economy is expanding. Why cut the rate now, and what does the Fed hope that this is going to accomplish?
Well, over the past 6 or 7 weeks, Fed officials have spoken publicly about things that were worrisome to them. And I think this really has to do with a global growth slowdown, but also continued uncertainty over trade policy and the fact that inflation remains pretty well below the Fed's target. So I think this was absolutely expected, but what the Fed's trying to do is act preemptively rather than being reactive. They say, let's do this now. We want to get ahead of a more pronounced slowdown.
Can you remind us what the Fed rate controls?
Absolutely. Now, the Federal Reserve controls short-term interest rates, so the Fed funds rate. And that means that when you borrow for short-term purposes, it's usually keyed off of something called the prime rate. So it's really kind of interesting because a lot of people think, oh, the Fed's cutting interest rates, that's why mortgage rates are down. Well, not exactly, because mortgage rates are tied to rates like the 10-year Treasury bond, and the Federal Reserve does not control them. But interestingly, those rates have dropped as well because of the same concerns. If global growth is slowing down, if growth here in the United States has already started to slow down, and we know that it has, then it means that interest rates overall should be starting to drop.
Okay, so we're looking right now at the markets. Dow Jones looks like it's down 27,000. How do you expect the markets to respond to the cut?
Well, I mean, look, it's going to bounce around. There's two thoughts around this. Number one is, okay, the Fed cut rates just by 1/4 point. Gee, as stock investors, we wish it were 1/2 point. But no one really thought that was going to happen. I think what's going to likely occur here is that the investment community is going to watch and see whether this is the first of a few more rate cuts. And if it is, I think stocks will react positively. If not, that's when you're going to start to see the market roll over.
And, people always want to know, how is this going to help me? How will Americans feel the impact, if at all?
First of all, I love that question because I know when people are watching this and listening to my voice, I can't see you, but I see you, viewers. Your eyes are rolling over saying, I'm so bored. Don't tell me. Okay, now I'm going to tell you why you should care. Wake up, because everyone should care. Here's why. If you are a saver, you care because now your savings rates that you're kind of like pretty psyched about, maybe you're getting 2% and a little bit more, you're tracking ahead of the inflation rate, those savings rates are going to drop. Now, if you are a borrower, get that big smile on your face because the interest you pay on everything from a credit card to an auto loan, maybe it's a home equity line of credit, those interest rates should drop a little bit, and that will be good news for you. Okay, I also want to say with a caveat, if you're paying more than 17% for an outstanding balance on a credit card, 1/4 point is not going to be the be-all, end-all, but it's moving in the right direction.
All right, Jill Schlesinger, thank you so much.